Make Better Wealth Decisions, a podcast that explores how financial advisors' blind spots can harm your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. One of the great things about discussing making better wealth decisions is when you get a chance to speak with people who actually make wealth decisions for a living. Now, this is the sort of thing that is very personal, and there are different strokes for different folks. I have met dozens of people with dozens of different philosophies and ways of doing things. So the point that I need to begin with is that there's no unequivocal, always right way, and there's no always wrong way. The thing that I would say about making better wealth decisions is that it's good to have a process, have a consistent way of doing things so that you can make decisions based on evidence, based on a way of a worldview that is consistent with what you think and not being swayed by fads or what your friends are doing. So having a process, having a set of values and sticking to it is probably the fundamental thing that is the most important element of making better decisions with regard to your money and what to invest in. That doesn't matter if you're using stocks and bonds, if you're using offering memorandum products, mutual funds, exchange traded funds, some combination of those. It doesn't really matter what you invest in. What matters is that you have a consistent way of doing it so that you do the same thing and look at the same information the same way all the time. Now, almost all styles will go in and out of favor at some time. So for instance, you will hear times of when this is a growth market and growth stocks are doing well, which ironically is what's been the case in 2023 and 2024, especially in the US with regard to the so-called Mag 7. So it's a very concentrated market where a small number of technology companies are leading the way. Other people, on the other hand, will be value investors, and they'll look for low PEs and a low price to book and stocks that are on sale or that are nonetheless cheap because they offer a margin of safety. I'm not suggesting you should do one or the other necessarily. In fact, many people use a combination of those, or some people will buy a benchmark where you're buying a whole variety of things, both high growth stocks and low cost value stocks. And if you buy them in some reasonable proportion, you've got de facto diversification with regard to your styles. Be consistent. The most important thing is to be consistent with regard to your focus and your discipline, and be careful about something that Annie Duke calls resulting. A lot of people will look at an investment, and if it's gone up, they'll say, wow, that was a good investment. And of course, if it's gone down, they'll say it was a bad investment. But really what you might want to think about is maybe taking some notes, thinking about, why did I buy this? Are the conditions that were surrounding my rationale for buying it still in place? And if your thesis was right or wrong, look not just at the decision you made and the outcome that you realized, but also at the rationale behind your decision, because making better decisions requires being more conscious of the decisions you make and why you make them. Hopefully you can learn from your mistakes. And we all make mistakes. It's not one of those things where you're going to be right all the time. No one is. But if you want to get better, you have to make a conscious effort to learn from your mistakes, diarize things, and make a concerted effort to get better at whatever it is you're doing. The thing that I would say most people agree on is to build portfolios that are broadly diversified. Now, that means diversify within and throughout asset classes. You have to be able to manage the major considerations such as concentration, trading too much, turnover, costs, whether you can buy individual stocks or maybe low-cost ETFs as opposed to high-cost products. That's a big one, and a lot of people do what they can to manage costs. And then, of course, rebalance on a consistent basis. Now, again, there are different people who have different points of view. Some will say a 10% variance. Some will say a contingent model. Some will say on an anniversary date or on your birthday or twice a year or once a year. The important thing about rebalancing is not that you choose one model or another, it's that you do it. So long as you rebalance in a way that is consistent, that works for you. If, for instance, turnover is important to you and you want to minimize taxes, maybe we rebalance a bit less. And of course, if the money is all registered, maybe it doesn't matter. So those are the sorts of things that you should think about. The important thing about making better wealth decisions is to be purposeful and consistent and to have a plan to do it the same way all the time so that you can learn and get better.
John DeGuy is a portfolio manager with Design Securities in Toronto. The views expressed in this program are not to be construed as specific advice. It is recommended that you consult a qualified advisor before taking action. His books, The Professional Financial Advisor 4, Stand Up to the Financial Services Industry and Bullshift are available through Amazon and in bookstores throughout Canada. You can reach John at 647-STAND-UP. That's 647-782-6387 or at jdeguy@designedsecurities.ca.